My big global guest tonight on this edition of Market Hour is Paul Donovan. He's Managing Director with UBS. He joins us from London. Paul, evening to you. Thank you for joining us. Paul, the latest data out of the Eurozone shows France has slipped into a recession in the first quarter, while Germany narrowly avoided that. But despite the steps taken by ECB and EU leaders and the EU leaders, things are only getting worse.
Well, I think the first thing the data shows is the complete absurdity of the concept of a recession. I mean, who cares if it's plus 0.1 or minus 0.1? It's all pretty much bad news. Now, we do have weather distortions in Europe. There's no question about that. We saw weakness in the construction sector, for example, with a very, very bad winter and a very, very slow start to the spring. So we've got to be aware that the data has been distorted downwards by these weather-related effects. Nevertheless, it's not a good picture for the Eurozone. Not only did the data come in weak, it came in worse than expected, even factoring in the bad weather in France, in Germany, in Italy. We've got the big three right there coming in worse than expected. So I think certainly there are signs of disappointing economic activity across the euro area.
What's the road ahead then for the Eurozone, Paul? How does one get growth back on track?
Well, Mr. Draghi at the ECB keeps going on about this, that one of the problems that we've got is the Eurozone banking system just isn't functioning properly. And in a modern capitalist society, if bank lending is below normal, you're going to end up with below normal economic activity. It is that simple. So what we really need to do, I think, in the Eurozone is come up with a comprehensive plan to tackle the banking system, to recapitalize the very weak Eurozone banks and get them back to lending normally. The trouble is, France and Germany are disagreeing more and more and more on how that should be achieved.
Paul, we know a large part of the market rally in Europe at least is on the back of excess liquidity. Do you think fundamentals will catch up soon then?
Well, actually, I'm afraid I disagree here. We can see that the market rally is actually not caused by excess liquidity. Firstly, because we don't have excess liquidity, and secondly, because there's no unusually high volumes in equity markets. That's not suggesting any liquidity problem. What has happened is central banks have removed risk from the markets, and that's a very, very different proposition. They've scaled back on risk and said, look, we're not going to allow there to be a liquidity crunch, we're not going to allow banks to fail. That's allowed markets to rally. Removing risk is one thing. The second thing is that equity market fundamentals in the euro area generally are supported by global economics far more than they are by Eurozone economics. It's always been the case that European equity markets are more closely correlated with the global economy than they are with the Eurozone economy. And of course, the global economy is performing a lot better than that of Europe. The US has been outperforming, Asia is relatively steady. So I think that the fundamentals are to a large extent being reflected by what we're seeing in terms of European market moves.
Paul, several policy makers and analysts are flagging off long-term risk to the cheap money. They say Fed's easy money policy between 2000 and 2006 was one of the causes for the financial crisis of 2008. Do you think we are building up to a crash while still recovering from the last one?
No, I think that we've got to be very careful in this sort of an interpretation. Central banks are not providing surplus money. They're providing liquidity at a time of extraordinary liquidity demand. The economic term is that the velocity of circulation has collapsed. So we're not providing huge amounts of surplus liquidity. I don't think we're providing necessarily huge problems. It is undoubtedly the case that when we're looking at quantitative policies around the world, providing quantitative policy isn't the difficult bit, it's the dismount at the end. It's the ending of quantitative policy that is the difficult bit. And that's where care needs to be taken. But I think certainly in the case of the Eurozone, also in the case of a number of other countries, perhaps less so now in the case of the United States, we are some considerable way away from the point where we have to drain liquidity.
Right, Paul, what is your take on U.S. economic data, which largely has been quite supportive? Their budget deficit is also shrinking. Are you of the view that US economy is now out of the woods?
I think the US is certainly heading in the right direction, and this year I think the US economic recovery, whilst it's not going to be dramatically above trend, is going to be a more solid, broad-based recovery. The foundations of the recovery are in a lot better condition than they are in the Eurozone. And that's largely because US banks are lending again. They've been lending to consumers for some time, and there is evidence now that they're starting to lend to the small business sector, which is absolutely critical to getting a sustained recovery in the States. So I think we are moving ahead. Now, we still need to be careful. The banking system is not 100% recovered. The housing market is showing early signs of recovery, but it's not fully stabilized. The labor market still has some considerable structural problems. And whilst the deficit has shrunk, that has been due in part to exceptional one-off factors. So there are still potential risks ahead. But I think, broadly speaking, the US is in a far better position than the Eurozone is at this stage.
What's your outlook on US markets, Paul? Do you see more gains going ahead?
Well, as far as US markets are concerned, I would describe myself as a reluctant optimist. I think that we have seen justifiable moves in markets. There's been some reduction in risk. A more broad-based recovery is a more secure recovery, so therefore that reduces uncertainties and risks, and that's all fine. At the same time, we are still talking about, at best, a trend-like rate of growth in the States next year, maybe a nominal GDP growth rate of something like 5 or 5.5%. And I think expectations for earnings are far too high when set against that sort of backdrop. So I think that there is upside in the US simply because there is a limited number of alternative asset classes that look as attractive. But at the same time, we are perhaps stretching a little bit with current valuations.
Well, the boom in equity markets from Frankfurt to New York to Tokyo is yet to reach Shanghai, looks like. Does this ring an alarm bell of sorts, you think?
No, equity markets have got very little to do with economics, frankly. Equity markets are focused on very large companies. We've just come out of a small business recession. We're in an environment where more liquid markets are able to respond to changing global economic circumstances, but investors are still very cautious about issues like liquidity risk, issues like corporate governance, issues like the rule of law. I mean, there's a whole series of specific issues which affect markets like those in Shanghai, which don't affect markets elsewhere in the world. So I don't think it's particularly surprising that we're seeing the differences in performance around the world. I mean, it's like things like the sudden drop in the gold price, which is simply a reflection of the illiquidity of that market rather than necessarily what's going on in real economics. It's the fact that the European equity markets are more focused on the global economy than the rather dire outlook in the Eurozone. We have to distinguish between the way in which equity markets perform and the way in which economies perform.
Paul, really appreciate your time.